Okay, I've got a question then now to continue this conversation. I've heard you use the word returns a lot.
Okay.
And I'm sure return depends then on the investment. So what is a low risk investment and what is a high risk investment?
Okay. So typically you'll find, or let me just answer specifically. A high risk investment is one where you could make a huge sum of money or return from investing in it, or you could lose all of it. So it's a high stakes game. So it's patapotea sort of thing, right? You could either make a lot of money or you could lose all of it. A low risk investment is where you invest your money and you know, it's going to be hard for me to lose my money. So for instance, I could decide I want to put my money in a fixed deposit account with a tier 1 bank in my country. That is a low risk investment because if it's a tier 1 bank, it means it's a solid bank. They have a huge balance sheet, they have huge assets, and it's unlikely that it's going to collapse in the next 1 year. But if I decide, hang on, Richie has decided he's going into transport business, buying trucks and transporting cement. And I'm like, Richie doesn't do that kind of work. But he's decided he's starting this business and he wants me to fund him. It's patapotea, Like I can analyze the business opportunity, I can look at all these different forecasts, but it is more risky, high risk for me to lend you 1 million shillings to fund your business and hopefully get my million and whatever else on top, and investing not investing, but saving my money in a bank account as a fixed deposit is low risk. Or lending my money to the government is low risk because really the government will pay me back.
Yep.
It's difficult. We don't see governments collapsing every day, right? So that's the difference. And typically you'll find high risk opportunities will go with high returns. Okay, so you make more money when the risk is high. Most times, but it's not all the time. Okay, it's not all the time. And then there's those ones where when low risk typically will give you low return. But in Kenya, it's interesting. We actually have an inverted yield curve in our bond market. What does that mean? It's low return when it's short term, high return when it's long term, right? That's how it should be. Because the longer you wait, okay, let me backtrack a bit.
Okay, backtrack.
What is an investment? What is an investment? An investment is putting your money in something that you want to grow and give you a return at the end of the day after a period of time. Okay, so you deny yourself. Today, I deny myself, I'll not go buy nice shoes, I'll not have my lunch, I don't know in which restaurant, so that I can save money and enjoy it later. Hopefully it will have grown, it will have been more. So this investment must pay me back for denying myself, so I need to be compensated for time. It needs to compensate me for risk that I might not get my money back. Okay. And it also needs to compensate me for inflation. Because if I deny myself now, today bread is 50 bob. Tomorrow or next year, it's going to be 52.
And in the Naira, it's 89%.
You understand, right?
I get it.
And so if I'm waiting longer, time is an issue where you're thinking about. It's not just return, it's also time. If I'm waiting longer to get my return, then I should get a higher return.
For sure.
But sometimes it doesn't always work that way. And for someone who is in another country where that's working, they'll look at Kenya and be like, what? I invest for 5 years and I get 17.9% because that's our current infrastructure bond return. Perhaps. Because in my country, it's 4.5%. And even if there is a depreciation in the Kenya shilling, it's probably going to be 3 to 5%. If 4 plus 3, you know what I mean?
Yes, I get
17 makes sense. And so they invest. In fact, the last infrastructure bond that happened...
Oversubscribed.
So
oversubscribed means so many people want that opportunity.
More
demand than supply.
Exactly. They got more than they asked for. And a lot of that money was from foreign investors. Because first of all, there's no tax and there's an opportunity. Okay, so I've mixed in many things. You're asking about returns. So returns are not just about risk, is what I was trying to talk about. It's also about time. And so as you look at opportunities, you're looking at, okay, for 5 years is what my investment horizon is. What can I invest my money that will give me a good return within that period of time without taking too much risk?
You know, as you speak And I'm so happy to hear you speak, because sometimes as individuals, we think that we can do this on our own. And I don't think that there's a space where we can't. But what I'm hearing from you as you begin to explain all this, it's a lot of work.
It is.
There's an analysis of the business. There's an understanding of how to invest, the timing to invest, the duration to invest, calculation of the inflation. All of this sounds like, hence the need for example, an investment company. What I'm just trying to say, it is work. What's your thought on that?
Absolutely, even for me, who is in this market, investing my own money
Yes.
is work. And so I'd rather give my money to Ian, give my money to Sandra, give my money to other people who are experts within our firm to manage for me, because it's a lot of work. And so it's advisable when you're investing in financial markets, to the extent possible, have somebody that you work with. Because then this person will guide you on, this is a time to buy, this is a time to sell, and you just have conversations with them, or invest in a fund. So for example, instead of you calling banks, oh, can you deposit for me? I have a deposit, just buy a money market fund. You know, instead of trying to find those returns yourself, just get into a fund, get into we call them collective investment scheme that enables you to have your money managed without you having this headache of trying to negotiate for yourself, trying to make things work for you, and yet there's somebody who is an expert on the desk daily, trying to maximize returns and minimize risk.
Okay, I love this. I've understood the introduction of this conversation. When we come back, we're going to take a short break. When we come back, I want to talk about the regulation. I want to talk about the safety net that has been put on to prevent people from losing their investment. Does it exist? Is it there? Let's come back and have that conversation.